This is something I've argued in some of my pieces where people tend to say if it gets too big, governments will ban it, whereas I tend to say the opposite. The bigger it gets, the more resistant it gets to banning because the donor class ends up owning it, politicians end up owning it, and it becomes a very large pool of capital. The bigger it gets, the harder it gets to deal with, in my view. And it's hard to say if we're really kind of fully past the event horizon. I think we pretty much are. One thing to keep in mind is that central banks do talk to each other. They have the Bank for International Settlements. They basically have a lot of coordination, and so you could kind of see a last-ditch effort to sever it from the banking system across multiple countries if something was really going wrong in their countries. Ironically, they would blame Bitcoin for things like their currency not starting to fail. For example, if people get tired of persistently negative real rates, they start to get out of the currency, and you start to get currency issues. They could, as a last-ditch effort, blame Bitcoin. And so I wouldn't say we're fully out of the woods, but at this point, you have reached, in my view, at least in the United States, some sort of critical mass where you have enough donors and politicians and things like that, where it's really, in any sort of rule of law country, it's really hard to outright ban it. I mean, I remember back when it was new, Bitcoin, and I was very busy back then, and just kind of I had a lot on my plate. And every time I would just think of Bitcoin, I would kind of just the UI just wasn't there yet. So it's kind of like I would kind of like maybe I should open an account on one of these exchanges and try it out. And I was just like, it looks sketchy. I don't know. So like I just never got past that point to actually put an hour into it and kind of figure it out. And so it's gotten to that point where it's gotten a lot easier for people to access. But yeah, you would shake people's confidence. You would bring on regulators probably if you were to have one of these enormous kind of whale institutions go down. And so that certainly affects people that are involved with leverage in any way, right? It's not something I generally recommend. But if you're a hodler, that shouldn't be kind of a catastrophic outcome. But it certainly is a price and adoption affected thing and a regulator thing. So eventually, people often ask what happens when all the coins are mined because they assume that miners just kind of go out of business. But that's not the case because there's also transaction fees. And they've been there since the beginning. But in the beginning, they were a very small percentage because blocks weren't even full. So once Bitcoin got big enough where it could reliably fill blocks, you started to get a more reliable fee market. But even that does vary considerably, right? So obviously fees earlier this year during the $60,000 bull market were very big compared to what they were during the bear market portion. And so over time, especially as we get into say the 2030s, the block subsidy will be small enough that the protocol will be more reliant on those fees paying miners. And it's one of those things where this is how adoption can affect security, because the bigger Bitcoin gets, while that block size is still tight, means that those blocks are more reliably full. Fees are pretty high in the base chain, and so that can keep security up long term. Part of why Bitcoin's network effect is so strong is because it has the highest security. And then the more adoption it attracts, the stronger that security gets. And so basically, with any kind of proof of work blockchain, you have a bunch of miners that are working to, find the next block, which grants them coins, which is pre-programmed to decrease every 4 years, the number of coins they get per block. That's the declining block subsidy, as well as any transaction fees that people are willing to pay to make sure that their transaction is toward the front of the line to get in that block. And so, the larger amount of miners backing that up makes it a much higher hurdle rate for anyone trying to do a 51% attack. And it's actually more risky. So Bitcoin's advantage is that in addition to it being the biggest cryptocurrency, it's by far the biggest proof of work, cryptocurrency, especially using the algorithm that it does. And so this is a risk for chains that are using the same proof of work algorithm as a bigger coin. So for example, Bitcoin Cash, Bitcoin Satoshi Vision, Ethereum Classic, these tend to be very vulnerable to 51% attacks because it only takes a percentage of that larger coin's miners to go after that smaller one. And so, for example, if 1% of Bitcoin miners are bored, they can go after Bitcoin SV and do a 51% attack and then go back to mining Bitcoin. And so that's why security is important. That's why Bitcoin and Bitcoin Cash are not the same, right? You don't have the same security assurances associated with them, and that's why many people view Bitcoin as money, but they don't view these other derivatives as money because they have far less security, far less hash rate, far higher probability of 51% attacks occurring. And so over the long run, the question becomes, will transaction fees be enough to make 51% attacks rare or impossible? And how do we adjust with that? And so I think, the short answer, I've done all kind of this math associated with it to see how it's scaled historically, how it could conceivably scale in the future based on a couple different outcomes. We can kind of model it like a matrix, right? So how big does Bitcoin get? What is the percentage of market cap or the percentage of annual transaction volume that takes place as fees, and is that enough to sustain it long term? And the answer is that as long as Bitcoin continues to grow, the answer is that it should be able to sustain itself. It should be able to generate multiple billions of dollars worth of fees per year, and that creates a pretty high hurdle rate for anyone to go after. And the challenging thing is that there's no proof of how much security is appropriate. It's one of those things that so far has been secured in practice, but not necessarily in theory, where we can walk through the steps it would take to do a 51% attack. I mean, you have to acquire 51% of the hardware, which is now very geographically distributed. So overall, that's what separates Bitcoin from other tokens, and is mainly why we view that one as money, and everything else is like at best an equity or at worst a scam. And so I view Bitcoin as the best chance we have in order to have, what people have pointed out. I mean, Henry Ford talked about a currency based on energy 100 years ago. And this is the best shot we have, I think, to come to this viewpoint happening. I think that's a really powerful idea. It's funny, people are worried about Bitcoin and the environment. I literally, as someone with electrical engineering background, I want Bitcoin to use more energy because it uses energy in such a useful way that it can actually, improve a lot of things. And so I'm very bullish on Bitcoin, and so that's one of the reasons I like to focus on it both positively and discuss the risks. So because I want people to understand them. I want people to see, the difference between Bitcoin and other protocols, what makes Bitcoin unique, and just people can continue to support this.